All right, here we are again. So we had already started looking at the balance of payments. I found a really excellent video that helps explain it in a little more detail. So I think we should start by watching that, and then we can get back to the notes. All right, so let's go over to Moodle. The link should be there. I want to make sure that everyone can have access to all those links. So, because of course, they're not going to show up in the videos in case you're watching the recordings. And so let's go back to our page, global economy. And here we go. I'll put it in here today. So this is a video about what it is and how it's calculated and what important information it gives us so that we can cover it in more detail. And then when this is done, we'll start looking more at exchange rates and currencies. Because now remember, this is the second half of the course, basically. The first half was all about, or I guess the first third was all about trade. The rest of the course is about international finance. Okay, so now all of a sudden, we're going to be focusing more on financial flows rather than flows of goods and services. Okay, so that in a nutshell is what really separates the two. Plus, international trade is more of a micro application, microeconomics, whereas this is more macro. All right, so what I'd like to do as usual is put the link. Oh, okay. Let's put the link in the chat room, and then we'll watch it, and then we'll go over it, and then we'll get back to the notes. Okay. So as usual, I will pause the screen sharing while this is going on to avoid any issues with YouTube. And so here it is. Let's check it out. All right. So first, let me pause, and then let's watch it.
I'm Mr. Lewis.
Uh, Okay, good.
Hey, everyone.
All right, I guess we're all more or less done. Well, that covered a lot, although there's one thing I did notice that I want to mention right now. Now, remember last time we were looking at the actual balance of payments accounts that I downloaded from the internet for the year 2019. Oh, I almost forgot. I got to get this thing back on. Yes, there we go. So I did want to point out, though, that the video is apparently a little bit outdated. They mentioned the current and the capital account. That used to be the way it worked. Fairly recently, the government decided for some oddball reason to move all the financial flows into the so-called financial account, where we have, like, for example, which you mentioned, if one country or a company in one country buys out a company in another country, that goes into this category, which is called direct investment. And if we buy foreign stocks and foreigners buy our stocks, that goes into this category, portfolio investment liabilities. But all of this is collectively known as the financial account now. For the capital account is this tiny little thing that they created a while back. I don't remember what year it was, where it really is nothing but these very specialized transactions that mostly take place between central banks. And I never really understood what the point of that was, but that's how they've been doing it for a while. So in the video, when he mentioned the capital account, that all now actually belongs to the financial account. So in other words, these are financial assets only. Up here, we have the actual flow of goods and services, imports, exports, income receipts like wages from working in a foreign country, or income from foreign investments. That belongs up here. But down here, we have the actual flows of funds when we buy foreign stocks and bonds, or when we buy foreign companies, or when we start up a company in a foreign country. That belongs down here in the financial account. And the bottom line is, in principle, these three accounts, the current account where we have exports and imports and net income receipts, that plus the capital account and the financial account theoretically should add up to zero. Usually it doesn't work that way because there are issues involved with gathering up this information that lead to problems. And so this last category here, the statistical discrepancy, basically is just there to make sure that everything adds up to zero. And these statistical discrepancies are not trivial amounts of money. This is $34 billion. Imagine a company, private company, saying, you know, we have a statistical discrepancy in our accounts worth $34 billion. Well, that wouldn't fly, would it? No. So you can see this is just a reflection of how difficult it is to properly estimate all of these numbers, because a lot of them involve transactions with foreign countries where the US government can't really get involved in trying to measure them properly. We have to take this information as given from those other countries. Also, as we've seen before, I mean, let's face it, there's a lot of, let's just say, non-legal activities that may have not found their way into these accounts. Okay. What did they say recently?
Oh, I was looking into this recently, and they recently did an audit a couple of years back, and their accounts, which they had originally been publicly claiming were about 20 billion, turned out to be about $100 billion.
Oh, well, that's good in a different way, because that means they had a lot more money than they thought. It makes me wonder, though, who their accountants were. But, you know, you can see how what can happen is a lot of the information may have been kept from them for privacy reasons or other reasons. And so it can happen. But yeah, you're right. I mean, that's a pretty big difference, though. I mean, here, the only thing we can say here is that we're talking about 30-something billion compared to the size of some of these other transactions, like $3 trillion, for example. So the statistical discrepancy isn't that enormous compared to the size of world trade, but it's still a lot of money. And again, it's a reflection of the difficulty of gathering up this material correctly. So we always have to take these numbers with a grain of salt, and that's just the reality. Even in this day with all the technology we have, we still have to rely on people to tell us the accurate information in order for these numbers to make sense. Well, all right then. So let's go back to the slides and see, where did we leave off? I don't remember. Let's just quickly review what we've seen. We start out by identifying how GDP is measured and GNP. I think I mentioned that GDP is now at this point in time the more popular measure, but they're both very important, and they're both an attempt to capture the amount of goods and services that a country produces during a given year. What really separates them is, in the case of GNP, we're focused on the nationality of the people who produce these products. In GDP, we're focused more on the location. Okay, so in other words, GDP means products that are produced in the United States, regardless of who produced them. And GNP refers to products produced by Americans, regardless of where they're located. All right, in fact, why don't I write that down? I like that. I'm going to do that right now because it's GNP, or US GNP, I should say, measures the products produced by Americans, or the value of the products produced by Americans, regardless of where they're located. In other words, if an American company is doing business in Australia, for example, it still counts because it's an American company, but US GDP measures the value of the products produced in within the borders of the United States. Regardless of who produces them. Okay, if you're working in the United States, if your company is located here, it doesn't matter if you are a Japanese company or an American company, those products will still be counted in our GDP. Okay, so let's remember that distinction, but also most of the time we'll be referring to GDP. Not all books. Some books do still use GNP, but it's not as common as it used to be. All right, so here we have the same thing. And I gave you a few examples. Let's just quickly run through them again. Ford obviously is an American company. At their factories in the UK, anything they produce gets counted in US GNP because it's an American company, whereas it's left out of GDP because it's being built in England or the United Kingdom, not the United States. So just as a fun side note, by the way, if you ever wondered what is the difference between the UK and England, the United Kingdom includes England, Scotland, Wales, and Northern Ireland. England is a separate country. It only means England. But the UK includes Scotland, Wales, and Northern Ireland. All right. Just in case you were wondering. So let's look at the UK, and from their perspective, the Ford cars are being counted in their GDP because they're being built in the United Kingdom, even though it's an American company. And whereas their GNP, no, because it's not a British company. Okay. On the other hand, if you look at a Japanese car company building in the US, which is Nissan, their cars would be counted in our GDP because they're being built in the US, but not our GNP because it's not an American company. Very good. Now, how about this case? From the perspective of the Japanese, the Nissan cars being built in the United States, they're counted in their GNP because it's a Japanese company, but not their GDP because they're not being built in Japan. Now, there's a lot of offsetting here. There's a lot of this balances out, so that as a result, there's a very small difference typically for many countries between the two measures. They typically end up being very close to each other, but there are countries where that's not true. Okay, so it can make a big difference which one we're referring to. All right, now We also saw that GDP itself can be broken up into the following components. And we see that we have personal consumption expenditures, which, by the way, in one of my other classes, I stumbled onto this website, and I'd like you to have this link. Where are we? So you can see what our GDP looks like. Let me just quickly put this link in the chat room, just to get a sense of the size of these numbers for the United States. Now, this is the Bureau of Economic Analysis. As you can see, BEA, Bureau of Economic Analysis, like every other government agency that gathers statistics, everything's free here. You just go to it and you download what you want. But here is a very nice compact discussion about the different components of US GDP. So you can get a feel for how large these numbers are. Now here, for example, at the end of last year, our GDP was up around $21.5 trillion. By far the largest economy in the world. Okay, now, how much of that came from consumer spending? It's called personal consumption expenditures. And that represents roughly 2/3 of the total. And so you can see that the consumer is really the one that's driving the state of the economy, because we're the ones who buy all these products, not all of them, but many of them. And so a lot of the output that's being produced is meant for the consumer market. And so this is by far the biggest sector of the economy. And you notice how they break it up into goods and services. And the durable goods are the ones that are meant to last for a long time. They're typically very expensive, and they're also typically financed with credit. So what goes into that category? That would be things that you don't buy very often, like cars and appliances and computers and all the rest. Those are the things that people will tend to cut back on when the economy is doing poorly. And in fact, if you notice, the first 2 quarters last year were heavily affected by COVID. Look what happened between the second and third quarter last year. Durable goods demand, oh my God, it went up quite a bit after falling off significantly due to the crisis. Non-durables are these. Now you notice they fell off too, but they're bouncing back to much more normal levels. And services, they went down a bit during the second quarter, but they bounced back very nicely. And then we have investment, gross private domestic investment. Now, except for the first part, or sorry, down here somewhere that we have it. Residential. Residential means, believe it or not, new housing. This is considered to be a form of investment by the government. Not even consumer spending, it's considered to be investment spending. So they lump that together with these other types of investment, which are primarily made by businesses. So we have in the fixed investment category, we have non-residential, which is business. And that's subdivided into structures, which are just buildings. We have equipment, you know, machinery, equipment, that type of thing that you need to produce consumer goods. We also have, look at this, intellectual property products like patents and trademarks. Those are worth a lot of money. And then finally, residential is here. And the last category is something called change in private inventories. Now, why is that there? The idea is that we want to capture the value of what's been produced in a given year. And so what happens is a lot of times products that are produced late in the year, especially durables, may not be sold until the following year. So in other words, you might find in this category new cars that were built in December. The ones that weren't sold until the following year are considered to be an increase in private inventories. Yes, okay, so they have to count it somewhere. And that's what they came up with. We'll call it an increase in private inventories because, let's face it, the cars that haven't been sold yet are sitting on the lot, and they will be sold, but not just yet. So we put those in this category. Now, here's an interesting thing to notice. If you look at the COVID impact, you'll notice that for inventories, they went from, these are more normal levels. They started to slow down at the end of the quarter four in 2019. And then look at them here. Dramatic reductions, minus 52.1 billion, minus 298.4 billion. This is a sign that businesses are nervous. Businesses do not build new products unless they're confident that they can sell them very quickly. If they're nervous, they're worried about the state of the economy, this is one of the first ways in which it shows up, is in a significant drop in private inventories. Now, it bounced back quite a bit in quarter three, and then by the time it got to be last fall, it was heading back towards more normal numbers. But that's a sign, you can tell right away just by looking at that some kind of disaster was taking place in the first 2 quarters of last year, and we know what it was, of course. And then finally, the component that we will spend most of our time looking at, or much of our time looking at here, is net exports. Of course, remember that means exports minus imports. And so here for the US, as usual, we have a deficit. It's been a long time since we had a surplus. Now, you can see what's causing this. Our exports were about $2.2 trillion last year, but we only we sold $2.2 trillion to foreigners, but we bought $3 trillion from them. That's what's causing this. All right. And now you can see the breakdown between goods and services. We typically have a small surplus with the services. We did the same thing last quarter or last fall. But it's in the goods part that we really have a huge deficit. We sold about $1.5 trillion worth of goods to foreigners, and they in turn, we bought back from them about 2.5 trillion. So right there's a gap of $1 trillion between what we sold to them and we bought back from them. And that's why this is happening right here. Now, it turns out, of course, this category is heavily, heavily influenced by exchange rates. Of course, the strength of the dollar. And so when the dollar, we'll see in the notes as we get to them, when the dollar gets stronger, we tend to have bigger deficits. And that's because our products become very expensive to foreigners. So in a way, a strong dollar may sound like a great thing, and it is to some degree, but it does definitely cause our trade balance to get worse. And then finally down here, we have government purchases. This only includes purchases, not transfer payments of physical goods and services, of which it breaks it down into federal and state and local. Okay, so these are the current numbers. If you want more details, you can go look. All these tables are available. There's so many of them. This is the one that we want, though. Oh, by the way, I'm going to download this into Excel so I can send you a copy. There it is. Okay. So that way we've got that. All right, so let's get back to the slides and quickly run through them again. So these are the 4 components as we just saw. And we already know how they're broken down, so we can skip through some of this. Durable goods are meant to last for a long time. As we've seen, they're typically financed with credit, so their demand is very heavily dependent on interest rates. Now, we will see more about this later on, but this means that monetary policy, by which I mean control of interest rates by the Federal Reserve System, can have a major impact on the demand for these products. In fact, if you look at today's news, let's jump over here to this really outstanding website called CNBC. You'll see that unusually, the Dow is doing well today, but the S&P 500 and the NASDAQ are getting pummeled. Well, not so much this one. The NASDAQ, apparently for whatever reason, investors are selling Apple and Tesla stock. And apparently the reason for that is because people are worried that the Fed may start raising rates in the near future. And if they do, it could harm Apple and Tesla more than many other companies because they apparently do a lot of borrowing at low rates of interest. So higher rates of interest would directly impact their profits. And because Apple and Tesla are major components of the NASDAQ and the S&P 500, all it takes is these two stocks to go down, and that's what happens to these indexes. Neither one of them are listed on the Dow, so therefore it can go up with these two going down. Now, here over this one, by the way, does anyone here follow cryptocurrencies? Apparently, Bitcoin is getting smacked around today. Yeah, they're all having a rough day.
Yeah, I've got an Ethereum miner sitting about 5 feet from me right now.
Really? Oh my God. So you're really an expert in this area. I know exactly nothing about this stuff except for the names. I've asked in the past people to explain it to me, and it never really made a lot of sense to me. So I just take it as it's some mysterious thing that I don't get. And I'm not going to be buying any of it anytime soon. But there it is if you're interested in more information about that. And but for our purposes, there's an FX or foreign exchange page, which soon enough, we're going to be analyzing currencies. And in fact, we're going to spend a lot of time looking at currencies. Why don't we take a peek at some of these? This one over here tells me that in order for me to buy, let's say I have euros in my pocket. Or actually, sorry, I have dollars in my pocket and I want to buy euros. Each one is going to cost me about $1.21 or so. The euro has traditionally been trading at a higher than level than the dollar. And you notice how this great website, they have this whole time series that takes us back to, oh, this is a year. Okay. So you can see that the euro is gaining ground against the dollar big time. So then you have to stop and ask why. Okay, there's always a lot of potential reasons for currencies to change because they're really ultimately affected by just about every factor out there. Not everything, not even just economics or finance, but a lot of psychology is involved with currency values. So if this is happening, is this a great time to go to Europe and save money? No, it's becoming expensive to buy euros. But let's see, what about some of these other ones? Oops, wrong one. This is the yen and the dollar. The Japanese yen, a dollar will buy 105.05 Japanese yen. The yen is always traded at a very low number like that. In other words, each yen is worth slightly less than a penny. And that's pretty much been stable for a while. Let's see what this has been looking like. Yeah, it's, by the way, back here, that meant that the yen was cheaper against the dollar. In other words, with the yen, the higher the exchange rate, the weaker the yen is. And we'll discuss this in great detail in the next chapter. So basically, the yen has recently been strengthening against the dollar. And this is how you can tell. Well, what else do we have here? What other goodies are in this list? Oh, the pound and the dollar. Now, this is interesting because about, God, what was it, 4 years ago now, 5 years ago, the British were involved in a very major event. Does anyone know what it was called?
Brexit.
Oh, Brexit, that's right. And so when along came Brexit, the pound suddenly crashed. Are they really going to do it? They talk about this all the time. Does anyone think they're really going to go through with it?
It's already done. They've closed the borders.
Did they really? You mean
Yeah, you
actually,
can't bring. Yeah, there was a huge catastrophe when they closed the borders to all organic produce, which means the British can't export their
that surprises
also,
me. Go ahead.
Yeah. Also a huge problem because they're having to search every truck that comes across the channel for sandwiches because those are now in violation of an
Sandwiches.
international border.
Oh my God, sandwiches. Oh my God. And imagine those British trying to export sandwiches to Scotland. Those nefarious Brits, I'm telling you. Um, no, the reason why this is surprising me is because, let's face it, Scotland is one of the poorest parts of the United Kingdom. And if they try to become a separate country, they're gonna be hurting for a while. What caused this to suddenly come on now? I wonder.
Brexit.
Oh, because they don't want to leave.
Yeah, they want to stay in the EU because they have resources that they want to extract to Europe, mostly
I see.
gas deposits.
Oh, this is bad. But yeah, the thing is that surprises me is because the British pound is doing very well these days compared to where it's been recently, mainly because of Brexit. Like I said.
Oh, wait, let me rephrase something. Brexit is done. The Scottish secession it's on the board.
Right. But they've been talking about this for a long time, but they never went to the step of closing the border. That's different. I don't remember that ever happening.
Oh, no, I misspoke terribly. The border between Britain and Holland and Britain and France and stuff. As a result of that, the SNP are pushing very, very hard because the Scots want to leave Britain. I'm terribly sorry.
Yeah, okay. I was going to say, close the border with England. That doesn't seem right. But, and in fact, in the 70s, there were several times when Quebec was saying, we're going to leave Canada, we're going to leave Canada. They actually put it up to a vote a couple of times, and the proposition lost, but they were openly talking about it, although it never quite, now that there's no discussion of it anymore. But yeah, for a while, there's a lot of agitation about that. But anyway, yeah, the British pound is doing well. They were down to about $1.20 when Brexit happened, even lower, and now they're up around $1.40 again for the first time in quite a while. So the markets must have decided, you know what, this is it. This is for real. There's no going back, and therefore maybe we can not be so panicked about it. I don't know what any other reason why they should suddenly start doing so well. Is there anyone else in here that we might want to pay attention to? The Canadian dollar. Yes, the Canadian dollar is very volatile compared to the US. And this means that right now, if you go to Canada with your dollars, you're basically getting a 26% discount off of everything you buy because each American dollar can buy 1.26 Canadian dollars. And in fact, it's been much higher. Going back only last year, wow. Each US dollar was worth about $1.45 Canadian. Boy, that would have really been the right time to be there. You would have saved a lot of money, that's for sure. No, yes, this is how many Canadian dollars it takes to buy one US dollar. It's not the other way around. In other words, this means 1.45 Canadian dollars are required to buy one US dollar. Okay, so that means the higher it goes, the weaker is the Canadian dollar. All right, let's go back. Who else is in this list that we might find exciting? Let's see. Oh, here we go. Australia. Yeah, Australia is usually considered to be one of the more important currencies. But if you really want to look at more detailed listings, they have up here, look under here for currencies. They'll have a lot more of them here. There's all kinds of them. Like, for example, look at this one. CHF. What currency do you suppose that represents? Oh, Chinese yuan. Yeah, I didn't see that quote here. The Chinese yuan is somewhat fixed compared to the dollar. We'll discuss that when we get to that chapter, but it doesn't really freely float against the dollar like these other currencies do. So the Chinese central bank basically intervenes and keeps it within a narrow range against the dollar. So that's not likely to change much in value unless something happens in China, something major. But anyway, if you look over here, there's US dollar compared to CHF. Does anyone want to take a guess what CHF stands for or which country it represents? It is the Swiss franc. How did you know that?
Oh, my senior project is on like foreign aid, so I have to go through annual reports, and so I got through that. I
Okay.
passed that currency before.
All right, cool. Now here's the reason for that. I think Wikipedia has an article about this. The bottom line is we call Switzerland Switzerland. That's not their real name. It is the Swiss Confederation, but their Latin name is completely unpronounceable. And it is, here it is. The official Latin name is Confederatio Helvetica. See, get it? CH. That's why it says CH, because that is what it means. So the Swiss franc is here, along with some of these other ones that we were just looking at. And so that's kind of interesting. CHF. Ooh, look at this. Janet Yellen is now the Treasury Secretary. She used to be the chairman of the Fed. I guess she doesn't like Bitcoin. Ooh. Well, you know what? That's her opinion. So anyway, I don't know. It doesn't mean anything to me. All right. So, all right, let's get back to this. Now, I believe the next chapter is where we start actually looking at foreign exchange markets, and we can have much deeper discussions about these different currencies. What we really want to analyze in those chapters is what exactly is causing these currencies to have these values. In other words, why is the yen so, why is it at 100? And why is the Swiss franc at, whatever? We want to understand the economic factors that determine the strengths of these different currencies with respect to each other. And it'll turn out a lot of this activity in these markets is driven by investors just simply looking for the highest rate of return that they can get from these different countries. In other words, if you've got money to invest, you may say to yourself, well, if I put my money in dollars, I'll get this kind of return. But if I hold Swiss francs, I'll get this kind of return. And that we'll see as a driving force between the values of these currencies, at least in the short run. A lot of it comes down to investments, not just trade, but investments as well. So, and that also revolves heavily around interest rates. Okay, so that's where that's all about. That we'll see. Don't you worry. This is coming up next. Whatever chapter this is, the next one, I think this is 10. 11 is where we start to dive very deeply into the foreign exchange markets. All right, so we mentioned already the non-durables are the ones you buy on a regular basis. The demand for these is not likely to be affected by interest rates. As you can see, why? Would you stop buying food because the Fed raised rates? I don't think so. All right. Private, we've already mentioned a lot of this. We have housing, which is called residential investment, non-residential or business investment. And here it simply means products that are purchased in order to help make consumer goods and services. And then finally, we have the changes in private inventories. Government expenditures, net exports, we know already what this means. All right, so this is good. We have our GDP identity, where all we do is consolidate all these categories, and all of these represent the entire output of the economy during a given year. Now, in macro classes, you'll spend a lot of time analyzing this GDP identity and the factors that influence these different components. And we're going to do some of that here too. But these are just abbreviations for consumer spending, investment spending, government spending, and finally net exports. Okay. And oh yeah, well, just want to briefly return to this quickly. GNP rather, includes these so-called net income receipts. Now, if you recall, income, or this is how it's formally defined, we're looking at the returns to these different factors of production, like wages are paid to workers or laborers, rent is paid to land, and profits are paid to capital owners. So these flow into and out of the country. So here's some quick examples of this. If I, as an American citizen, buy a British bond, any interest payments that they pay me, which are known as coupon payments, go into this GNP, but not GDP. And the reason why it's not going into GDP is because this is wealth that was not generated in the United States. Okay, I received it, but this was generated by the British government, not by the American government. So it gets counted in GNP because I'm an American citizen, but not GDP because this happened outside the borders of the United States. All right, what other examples could we have about this? If U.S. firm owns a retail store, suppose that Starbucks has it's hard to imagine that they don't, but let's say they have a Starbucks in Paris. The profits from the store would go into our GNP because, again, profits are returns to entrepreneurship and capital owners. But because it's an American company, we put those profits in GNP, but not GDP because they're coming from France. Okay. If a British citizen buys a share of IBM stock, the dividend payments actually come out of GNP in the US. They reduce it because we're paying funds to a British citizen. So outflows are going to reduce our GNP. Inflows will increase it. And here it does not, again, count in GDP because this is not taking place in the United States. Now, what else? Oh, okay. So income paid to U.S. citizens by foreigners adds to our GNP, but income paid to foreigners by us reduces our GNP. But in both cases, it does not count in GDP. Very good. Now, so therefore, we can create an identity for GNP, which looks very much like the identity for GDP. In other words, GNP equals GDP plus the net income receipts, which means we have the four components of GDP plus net income receipts. And that's how they're tied together. Now, those net income receipts, by the way, can be positive and they can be negative. So our GDP could be less than our GNP, they could be equal, or GDP could be greater. But for the United States and many other Western European countries, the difference between the two is usually very small in percentage terms. So we'll focus most of our attention here on GDP. Okay, so that, right, exactly. So it could go either way. For the US, it's very small. It's typically around 1% or maybe less. Now, on the other hand, you do have countries that owe a lot of debt to foreigners. And when that happens, they're paying a lot of interest to those foreigners, which reduces their GNP. And so their GDP might be much higher than their GNP because all that interest is flowing out of the country to these investors who hold their debt. Some examples would be Brazil and Argentina, who owe a lot of foreign debt, and much of it is held by American investors. So the balance of payments, as we started to discuss already, is that record of these transactions, and it tries to capture what's coming into and out of the country. We have the actual flow of physical goods and services. We have investment flows, which means potentially stocks and bonds or other investments, or also the acquisition of foreign companies, foreign assets, things like that. And then sometimes central banks do make transactions with each other, although it's very rare these days. And we'll see later on in the course, when we start looking at the history of the international financial system, that when countries were on the gold standard, there were a lot of transactions between central banks. Gold flowed into and out of the country in response to debts, and that's how it worked. And so now, not so much. In fact, if you want to know how little this happens, if you have ever been, the Federal Reserve system has a branch in New York City, which has something very interesting in the basement. What is that something? Let me show you a picture of it. Ooh, somebody already knows. The gold, that's right.
We went on a field trip when I was in 3rd grade.
Oh, you did? Oh, wow. I bet that was really cool when you were in the 3rd grade. There's a lot of gold down there in the basement of the Fed. Now, it all belongs to foreign central banks or foreign governments. So what is it doing down there? Well, what happens originally, a lot of it was put down there during World War II for safekeeping, but it was also used to settle international transactions. I mean, imagine how much easier it is to ship gold between 2 different lockers in the basement of the New York Fed than to ship it overseas in payment for debts that are accumulated. Well, here's the interesting thing. So after World War II ended, we were on the gold standard, the gold international standard, where we were settling debts in gold for about another 25 or so years. And then in 1971, pretty much that was the end of it. From that point on, no gold was being used to settle international transactions. And so the gold is sitting there. And interestingly enough, you would think these countries would want it back, but they don't. And that's because the Fed stores it for them very safely, and they don't charge them a fee. It's just a service that they're doing for these other central banks. So if you're Belgium, for example, and they have all these gold bars that belong to you, you know they're safe. Why do you want them back? You don't. So they sit down there, and tourists can come down there and see the gold bars and stare at them and admire these enormous stacks of gold bars. It's pretty cool. In fact, it's really one of the big highlights of the tour of the Federal Reserve Bank of New York, the gold vaults. Now, everybody knows the gold is down there, so that let's just say the security is tight, very tight, very, very tight. But keep in mind, this is not industrial gold. This is monetary gold. This is as pure as it gets. Okay, so each bar, as small as it looks, weighs something like 27 pounds. So that the workers have to wear titanium shoes, because if that fell on your foot, you'd be in the hospital for quite a while. And so each one is marked, and it has serial numbers on it, but it doesn't tell you who it belongs to. Now, the lockers themselves, if you do go down there, they will not tell you which locker belongs to which country. It is a secret. It's proprietary information. But the reason why I brought all this up is because the last time I was down there, the tour guide said that in the previous decade, there'd only been 3 times when gold was actually brought in or taken out of those vaults, or those lockers rather, which shows you how very infrequent it is these days that transactions are made with gold between central banks. 3 times in 10 years. That's not very often. But yeah, it's an amazing thing to see. If you ever get a chance to go down there, you've got to see this. It's insane. I mean, just looking at all this gold just sitting there, not that you're allowed to touch it or anything, or even take pictures, but you're allowed to look at it and admire it from a distance. And so that's what's going on down there. And of course, like I said, until, that period in history, right now, our currencies are not in any way related to gold, but for many centuries they were. Their values were directly tied to gold, And so this is like an historical artifact of those days. Anyway, we'll get more into that again when we get to that chapter where we talk about the gold standard. But here, the balance of payments, which we already have seen, it has the 4 components. Current account is where the trade balance resides. We have the capital account, which is, like I said, now a very tiny account. The financial account looks at the financial flows. And finally, the statistical discrepancy is there to balance it out. Because the sad reality is they're not going to add up to 0 because the information is not perfect. All right, and so we've already been looking at this, so maybe we don't have to go through this in such great detail. The one thing we didn't mention, net unilateral transfers do show up in the current account. Here it is, and let's see if we can find them. They would be in the current account, probably in a separate category. Man. It might be this. I'm not sure. I'd have to look it up. But anyway, what does this suggest to you? What does the word unilateral mean? It means one way. So a unilateral transfer means these are gifts, okay? So in other words, when the US government gives foreign aid to other countries, that's a unilateral transfer. If foreigners working abroad, or if foreigners working in the United States send their wages back home, that's a unilateral transfer out of the country. So in other words, as long as there's money flowing for something in such a way that there's nothing is expected in return. Like, in other words, if the US sends money to Egypt and doesn't expect anything in return, that is considered to be foreign aid, but specifically here, it is known as a net unilateral transfer. So that shows up in the current account. It's a very small amount of money. Let's see, maybe they mention it down here. They must be calling it something else here. Yeah, they don't specifically mention it. But anyway, but it is being counted in there. And then there's all this discussion, if you're keeping track of this information, transfers out of the country are negative flows, they're outflows. Transfers to domestic citizens are considered to be positive because they're inflows into the country. So the current account balance, in principle, is the trade balance or net exports, plus all the net income receipts, plus these unilateral transfers. So the current account balance is actually a broader measure of our trade with the other countries than the current account balance. Than the trade balance. In other words, the trade balance does not include these net income receipts or the unilateral transfers. Now, some years the current account deficit is worse than the trade deficit. Some years it's better. In fact, I don't know if we can find that on here. The current account deficit here is negative 449,693, whereas the let's see, where was that? I don't see anywhere where they've actually calculated the trade balance. But we can figure it out. But here they're more they're more interested in the balance in the current account. But anyway, yeah, so often in textbooks, they'll just set this equal to 0 because it's such a trivial amount of money. And then basically treat the current account balance as just the trade balance plus these net income receipts. It's just easier that way. So therefore, we can bring this all together now, and we can see that there's a GDP identity. If we treat the current account balance as simply the trade balance plus net income receipts, then we have this as our GNP identity, where the last term is not net exports, but the current account balance. All right, so that's our GNP identity. So yes, and like I said, the differences are very small for countries like the United States. All right, now the capital account, I think I mentioned earlier, it is a very tiny account. It only has a few specialized transactions. I would have thought they could have just as easily put this in a footnote or something. I don't know whose idea this was, but the capital account used to be the one that had all the financial flows. Now, all of a sudden, it's this trivial little thing that you hardly even notice it. And then the rest goes into the financial account. Yeah, that's what they did. I don't know. And then the financial account. Now, what's interesting about the financial account is that it has all these financial flows like stocks and bonds and actual physical assets like buildings. And it also refers to the ownership of foreign businesses. But it also has this item hiding down there called net financial derivatives. Now, does anyone know what a derivative is? Ooh, all right. Let me write down some of the names of some of these securities, and you let me know if you've heard of any of these. Forward contracts, futures contracts, swaps, and options are all examples of derivative securities. What are these things? All right. Oh, okay. Somebody knows. All right. Woohoo. They're contracts. Ultimately, they're contracts to buy and sell things, but they're complicated. They're more complicated than that, but that's what they're ultimately all about. They give you the right to buy or sell something in the future, and the price is determined today. So the purpose of these derivatives mainly, and this is not necessarily what they're used for in practice, but derivatives are designed to hedge risk. Okay, now we will also have this discussion later on in the course, but for example, an importer may want to lock in the price at which he can buy British pounds in 3 months. He can do so with a forward contract. In other words, you enter into an agreement and say, listen, in 3 months, I want to buy pounds and I agree to pay, let's say, $1.40 for each one. It's a very simple idea, but it means that we can eliminate foreign exchange risk. So you might say, well, that's wonderful, and it is, but they can also be used to speculate. What does that word speculate mean in this context? Oh, the difference between a future and an option is the option means you can change your mind. The future means you're obligated to do something. Well, don't worry, we'll discuss all this in that chapter. There's definitely a chapter here somewhere that goes over foreign exchange derivatives, and we'll definitely get to that because it's awfully, awfully important. Anyway, the problem here is that they can be used to speculate or gamble. And there's been many episodes in the recent 20, 30, 40 years where catastrophic losses took place because companies use these very unwisely. And so they're very, very risky. They can be used, if you use them correctly, it's kind of like dynamite, I guess. If dynamite is used correctly, it can do a lot of important things, like making it possible to build bridges where there used to be rocks, let's say. But if they're not used carefully, obviously dynamite can cause a lot of problems. So, in fact, so derivatives are very unusual type of security because they don't have a value of their own. Their values taken from whatever it is that you're allowed to buy or sell. So the contract that lets you buy British pounds, its value depends on the British pound. And that's it. The value of the contract depends on how much the British pound has changed since you entered into the contract. So the logic here is that a lot of these derivatives are used to hedge foreign exchange exposure. And so they end up being listed separately. They're down here somewhere. Financial derivatives are listed in their own separate category because they're so different from other types of securities. All right. The thinking is that they don't really belong up here with equity and debt, which are stocks and bonds. They really are a truly different type of security, so they're listed down here. Okay, so that's what that's all about. It's a very interesting area of study. U.S. assets held abroad, see how it's net of financial derivatives. Here we have U.S. private assets. Foreign direct investment means we own foreign properties, we own foreign businesses. Portfolio investment refers to the purchase of foreign stocks and bonds. Government assets, if the government owns, like for example, if the military has a base in Germany, which they do, that technically belongs to the U.S. government. All right, so that would get counted in that category. U.S. official reserve assets, this usually refers to gold held by the Federal Reserve System. And there's other things in there too. Oh, let me leave that there so you can catch up. All right, so then, so foreign direct investment means the purchase of foreign financial firms and other real assets. Real just means not financial by U.S. citizens. Okay, so if an American company buys out a company in Paris, that becomes a real asset. That's foreign direct investment. The reason why they make a distinction here is because when foreign direct investment is made, it's a very long-term commitment. It doesn't change overnight. Whereas the portfolio investment, the stocks and bonds, that can change very, very quickly. And so if there's even a slight change in interest rates or exchange rates, portfolio investment can move very quickly from one country to the next, and it often does. But not this right here. Foreign direct investment tends to be a long-term commitment, and so it tends to be very stable. So like, yeah, portfolio investment would be the purchase of foreign assets like stocks and bonds, or if you choose to keep your money in a foreign bank, this is all considered portfolio investment. And that, again, is something that can change very quickly depending on the level of interest rates and exchange rates in the two countries. All right, so government assets. The U.S. government has a lot of assets of its own. Often these are U.S. Treasury bonds. These may be foreign bonds. The government owns a lot of bonds issued by different governments. It owns a lot of other types of assets as well, but here we're focusing exclusively on financial assets. And then reserve assets, typically this would be gold, but it could also include foreign currencies as well. In fact, and again, this is something else we'll see later on in the course, the central bank of any country can intervene in foreign exchange markets by either buying or selling foreign currencies to either strengthen or weaken their own currency. And so these are the holdings of those currencies that are needed to do this. Okay, so yeah, we'll see more about that later on too. All right, and then this just works in reverse. In other words, those were American-owned financial assets. This is just coming from the other direction. Foreigners can buy American companies. They can buy foreign American stocks and bonds. Foreign governments can own assets in the United States. And there can also be foreign reserves in the U.S. Like I said, with the gold in the basement of the New York Fed, a lot of that belongs to foreign countries. And so therefore, that would be considered foreign official reserves in the U.S. By the way, where do you suppose the U.S. keeps its gold? In other words, it's not in the basement of the Fed. The United States keeps much of its gold, at least, in another area. Who knows what it's called? Fort Knox. Does anyone know what state it's in? Yes, it is Fort Knox. Now I'm going to test you even further. It's in Kentucky. Yes, that's where a large percentage of our gold is kept. It's not commonly known, but some of it at least is held at West Point as well. And in fact, there's a mint at West Point where they make gold coins out of it. I guess they figure the security is pretty tight. Yeah, at Fort West Point, so they don't have to worry about anything being stolen. That's right. Yeah, you don't want to steal anything from West Point. It's not going to end well for you. All right. So, all right. Yes, and net financial derivatives. So the sale of derivatives to foreigners is recorded as a positive inflow. This purchase of derivatives from foreigners is recorded as a negative outflow. Because derivatives are available for sale in every country in the world, it's not just the United States, although most of them are traded here. The ones that are not are usually traded in London. But, every major city throughout the world has its own derivatives exchanges. It's just that most of them are here, as you can probably guess. So anyway, then what we do is we bring all these together and we end up combining net, the difference between foreign and domestic, foreign direct investment, net portfolio investment, net financial derivatives. All of that ultimately becomes the financial account balance, which for the United States is typically positive, by the way. Okay, so in other words, the current account is almost always negative for the US, but the financial account is almost always positive. I don't know if there's any data online that can show this to us. You know what? Let's take a shot at this. Let's go to Fred. They may have it. The financial account. Let's make it annually, not seasonal adjusted. Let's see what it looks like. Oh, baby. Ooh, look at that. All of a sudden, it's gotten negative too. Oh my God. Well, that surprises me that it's gotten so out of hand. For the longest time, it was either about even or positive, but wow, I guess I misremembered that because those were all negatives. Ouch. Look at that. That's a lot of deficits. So that means we have a deficit in the current account and the financial account. Ouch. Let me just see something here. U.S. current account balance. This is quarterly, but still. I mean, the positive is, up here somewhere. I guess they figure we'll never have a positive current account ever again anyway, so why even bother? Okay, this would look even worse if it was annual, let me tell you. Hold on. Oh, no, why is this so hard to find? That's right, we can look at it later. All right, so, but anyway, and then of course our old friend, the statistical discrepancy is there because you know what's going to happen. There will always be problems, and so that's there to represent whatever's missing. And why does this happen? Well, first of all, the data that they use to construct the balance of payments comes from different sources throughout the world. Sometimes it's hard to measure capital flows because of privacy issues. Maybe people don't want to admit it when they've been buying foreign bonds. Who knows? And what else could go wrong here? Not all transactions are measured. That's right. So you know how when you come back from a foreign country on a plane into the United States, they give you these little cards to fill out, and they ask you if you're bringing back merchandise from abroad, which is worth, I think the cutoff point now is $800. And if you say no, that means everything you bring into the country, which technically is an import, is not being counted. All right. So if you bring in $400 worth of souvenirs from London, that's not getting counted anywhere. And they're missing all of that. And of course, illegal, nobody thinks that illegal activity is going to be reported anywhere, and it's not. And then, of course, human error is always a potential problem. All right. So that's why we have the statistical discrepancy, so that those can all add up to zero. And then everybody's happy. Okay. All right. Now, what kinds of variables do influence the balance of payments? So this is just the tip of the iceberg. We're just going to be looking at, in a big picture sense, how these values, or these variables, I should say, affect our balance of payments. Now, these are important factors like GDP, the exchange rate, interest rates, and inflation rates. They all have some influence on the balance of payments. All right, so for example, what about GDP? What would happen if GDP grows? That's good news for the economy, but guess what? That has a tendency to worsen our trade balance and our current account balance. Why would that be? All right, let's find out. Well, as GDP rises, domestic citizens spend more on all goods and services, including imports. On the other hand, foreigners will not buy more of our products just because our economy is expanding. So basically, exports stay the same, imports rise, and before you know it, the current trade balance worsens, and so does the current account balance. So while that sounds like great news, a rising economy, it can have a negative effect on GDP. On the trade balance. In fact, if you look at the charts of our trade deficit, you'll notice they tend to improve dramatically during a recession, and then they go right back to where they started from. All right, so that's GDP. In a nutshell, the exchange rate, we're going to spend a lot of time discussing this, but when the dollar gets weaker, that actually helps the current account balance because our merchandise that we're selling is cheaper in foreign countries. On the other hand, when the dollar gets stronger, the opposite happens. So a stronger dollar, again, sounds like a great development, but in terms of our trade deficit, it's actually not good at all. So it sounds backwards, but this is exactly what's happening. We're going to prove it in maybe, I think the next chapter has a discussion about this. Good example. Oh, I'm glad this is here. All right. So a U.S. firm has committed to buying 100,000 bottles of Bordeaux at a French price of 30 euros per bottle. Now, remember, it's an American company. We have to buy those euros in the foreign exchange markets. So let's say the current exchange rate is $1.30 per euro, which this is the symbol, the really cool symbol for the euro. How much will they cost us? We multiply 100,000 bottles by 30 euros per bottle times the exchange rate of $1.30 per euro. So we're going to be paying $3.9 million for those bottles. So the question is, what happens if the exchange rate changes? Because that will directly affect not the euro price of the bottles, but the dollar price of the euros. That's the problem right there. Well, you can probably see where this is going. For example, I think the next example is the dollar getting weaker. So suppose the dollar gets weaker, which means the exchange rate goes up so that it takes more dollars to buy a euro. What will happen to the cost of these euros? Good point. Good question. Let's see what happens if the exchange rate goes up to $1.40. That means the importer will have to pay $4.2 million instead of $3.9 million for those bottles of Bordeaux. So the weaker dollar is making this product more expensive in the United States, which means Americans will not buy as much of it. Okay, so the weaker dollar reduces imports because they become more expensive. On the other hand, what about a French company that's buying 100,000 bottles of California Chardonnay at a cost of $30 a bottle? When the exchange rate was $1.30, they were paying 2,307,692 euros to acquire these bottles. So we have to visualize what will happen if the exchange rate goes up to $1.40. Now, the key to the whole thing here is that we're dividing now. Down here, you can see we're not multiplying by the exchange rate, we're dividing. So now we're going to divide by a larger number, which means this is going to go down. So in other words, the weaker dollar will cause the cost of the Chardonnay to be cheaper in France. So let's take a look at how much the difference is. Oh, look at that. It fell by about 150,000 euros. And so therefore, people in France will buy more California Chardonnay. So two things are happening. Americans are buying less French wine. The French are buying more American wine, and it's all because of the weaker dollar. Okay, so the weaker dollar sounds like a negative development, but it does help with the trade balance, doesn't it? Yes. So therefore, yes, a weaker dollar reduces imports into the US, increases exports from the United States to foreign countries, which means a trade deficit is reduced, and therefore so is the current account balance. Now, one more thing, and that's the interest rates. The interest rates. Now, here we're thinking in terms of investment, by the way. You have to visualize that at this point in time, you could easily convert your dollars into any other currency and then put your money in foreign bank accounts. And so what we're going to see here is that if US rates go up, people will want to put more money in your country and less in their own. So in other words, a higher US interest rate will attract a lot of capital into the United States, which means the financial account will improve. Okay. So higher interest rates in the US improve the financial account balance. Falling interest rates have to do the opposite. And then I didn't realize there's one more, inflation. Now, inflation is harmful to any economy. It makes a country's products more expensive. So you can probably guess where this is going. If the US inflation rate goes up, people will buy less American goods and our trade deficit will get worse. But if our inflation rate goes down, people are more likely to buy our products and our trade balance will improve. And those are the basic factors. So we're just touching on them. We'll see more of these in the later chapters as we go along. But what we want to do next in our next class is we're going to spend a lot more time looking at exchange rates and what determines their values and how they in turn affect the domestic and foreign economies. So I think you'll find that to be extremely interesting. So right now, it's getting late. I guess we'll have to stop right here. That was it for 10. And so when we come back on Thursday, we'll start looking at our next chapter, which is our introduction to foreign exchange. Okay. All right. So I guess that will be it for now.
Thank you.
All right. See you next time.
Thank you. Have a good day.
Okay. Bye.
Have a good one.